One of the most powerful tax strategies for high-earning freelancers is electing S corporation status. And the whole strategy comes down to understanding one thing. How you pay yourself matters enormously for taxes. Specifically, the split between your salary and your distributions determines how much of your income gets hit with payroll taxes. Here is the exact strategy. How it works, what the IRS requires, and the real dollar savings at stake. First, let's understand the problem the S Corp is solving. As a sole proprietor, every dollar of your net profit is subject to self-employment tax, which is 15.3% on the first $100,000 and 2.9% above that. On $100,000 of profit, you pay roughly $14,130 in SE tax alone, on top of income tax. That SE tax is the equivalent of both the employer and employee portions of Social Security and Medicare. You are paying both sides. When you elect S Corp status, you split your income into two buckets, salary and distributions. Salary is subject to payroll taxes, FICA, the same 15.3% structure. But distributions from your S Corp flow through to your personal return as business income, not wages, and they are not subject to payroll taxes at all. So if you earn $150,000 in profit and you pay yourself a $60,000 salary, only the $60,000 gets hit with FICA taxes. The remaining $90,000 passes through as a distribution and avoids payroll taxes entirely. That saves you roughly $13,770 in payroll taxes per year. That is the strategy. But here is where most people get it wrong, and where the IRS is watching. You cannot pay yourself a $1 salary and take everything as a distribution. The IRS requires that you pay yourself reasonable compensation for the services you perform for the business. This is not optional. It is a firm requirement backed by decades of court cases. What is reasonable compensation? The IRS looks at several factors. What are your duties and responsibilities? What experience, training, and credentials do you have? What would it cost to hire someone to do what you do? What are comparable salaries in your industry for someone with your role? How profitable is the business and how much did your personal services contribute to that profit? The IRS has won court cases against business owners who paid token salaries. In the Watson case, a CPA earning $200,000 tried to pay himself $24,000 in salary. The court reclassified a large portion of his distributions as wages and imposed back taxes, interest, and penalties. This is a well-documented area of IRS enforcement. The common rule of thumb you will hear is the 60-40 split. 60% of profit as salary, 40% as distribution. This is not an official IRS guideline. It is a starting point used by many CPAs. The actual reasonable compensation number should be based on what someone with your skills and role would earn in the open market. One practical benchmark the IRS pays attention to. If your distributions are more than 2 times your salary, a 2.1 ratio, that is a red flag that can trigger scrutiny. You do not want your salary to look like an afterthought. Here is a concrete example. You earn $150,000 in net profit as a freelance software developer. You and your CPA determine that a reasonable salary for your role is $70,000 based on comparable market rates. You pay yourself $70,000 in salary through payroll. The remaining $80,000 flows out as a distribution. Payroll taxes on the $70,000 salary, roughly $10,710. Under a sole proprietorship with no S Corp, you would have paid SE tax on the full $150,000. Which is roughly $2,120 after the SE deduction adjustment. The S Corp saves you approximately $10,530 in this scenario. At $150,000 with a $60,000 salary and $90,000 distribution, you save roughly $13,770 compared to a full sole proprietorship situation. Does this make sense for everyone? No. The S Corp comes with real costs that eat into those savings. You will need to run payroll throughout the year, which typically costs $500 to $1,500 per year through a payroll service. Need to file quarterly payroll tax returns. Your accountant fees will be higher because your tax situation is more complex. Typically $1,000 to $3,000 more per year than a standard Schedule C return. You may also need to file a separate state business return. When you add up those extra costs, typically $2,000 to $5,000 per year, the S-Corp strategy starts making financial sense at roughly $80,000 to $100,000 in net profit. Below that threshold, you might break even, or even come out behind after accounting for the extra complexity and fees. Here is the process for setting this up. You first form an LLC or a corporation, typically at the state level. Then you file IRS Form 2553 to elect S-Corporation tax treatment. That form has a deadline. Generally, you must file within 75 days of the start of the tax year you want the election to take effect, or within 75 days of forming the entity. For an existing business, you can elect for the following tax year. Once you are an S-Corp, you must run payroll for yourself. You will get a W-2 at year-end showing your wages. Your remaining profit flows through on Schedule K-1 and is reported on your personal return. The K-1 income is your distribution. Ordinary income taxed at regular income tax rates, but not subject to self-employment or payroll taxes. You also retain the ability to deduct the self-employed health insurance deduction, though the mechanics work slightly differently as an S-Corp shareholder. Your premiums need to be included in your W-2 wages and then deducted on Schedule 1. Work with your CPA on this. The penalties for getting the reasonable compensation wrong are serious. If the IRS reclassifies distributions as wages, you owe the payroll taxes that should have been withheld plus interest, plus an accuracy-related penalty that can be 20% to 40% of the underpayment. The penalties accumulate fast. Bottom line, the S-Corp salary versus distribution strategy is legitimate, powerful, and IRS approved when done correctly. It requires paying yourself a reasonable salary, running actual payroll, and working with a CPA who understands the rules. If you are earning $80,000 or more as a freelancer, this conversation with your accountant is worth tens of thousands of dollars over the years you run your business. Subscribe for more advanced tax strategies built specifically for freelancers. See you in the next one.